Welcome to Value Investor TV podcast. This is a podcast that helps you grow your wealth and become financially independent. My name is Becco, and my partner, Hari Radhakrishnan. And this is episode 16, balance sheet. And balance sheet is specifically asset part of the balance sheet. As a quick reminder of what we talked about in the previous two episodes, we talked about income statement. Remember, we broke it down into two different episodes. The income statement we talked about from the top line all the way to the bottom line, and broke it down into. First episode was all about from top line to operating margin, operating income, and then the last part of the second part of the episode of the income statement. It was about the last leg of the journey from the operational income to the bottom line. Now today we want to move on to the second financial statement, that is balance sheet, and we want to tell you about that. But before we do that, why don't we take a quick overview of what the balance sheet is and dive into the asset portion of it. So, Hari, I mentioned earlier that balance sheet is broken down into asset and liability and equity. So can you tell us a little bit about the overview, and then we can go into the asset more in detail?
Yeah, you've probably, I think we used this analogy before. You've probably heard of those three terms, assets, liabilities, and equity. If you've ever talked about a home loan or a mortgage, the asset is what you own, the liability is what you owe, and the equity is the difference between the two.
Mm-hmm. Can you repeat that one more time?
Yeah, so the asset is what you own.
What I own, yes.
The liability is what you owe,
mm-hmm.
To the bank or to the creditors,
Yep.
And then the equity is the difference between the two. Mm-hmm. And so when you start talking about assets, liabilities, and equity, right, that same concept, whether it's a mortgage or a company's balance sheet, is the same. And so it's important to remember that the balance sheet is kind of like your bank statement. Mm-hmm. So the bank will send you a statement at the end of the month, the end of the quarter, or whatever, and it'll have a date on it. And that is, as of this date, these are what you own, what you owe, and the difference between the two.
Yeah.
Right? Which is what's called the equity. And the equity in this case is actually what the shareholders own. Mm-hmm. So yes. So the owners of the company own that component of it.
Right. Sometimes we'll say shareholders' equity.
Yes. So that term is synonymous with shareholders' equity. So, when you start looking at the balance sheet, you may see that term. And then the other term that you may look at and get confused with is because finance loves to have 17 terms for the same thing.
All these acronyms too. Yeah.
Book value is the same as equity. Mm-hmm. So if you hear that term book value, or you hear the term equity, it refers to the same thing.
Mm-hmm. Right. And actually, one idea just came to my mind. Before we dive into asset and dive more into the balance sheet, break it apart, can you tell the listeners why balance sheet is important and why it is different than income statement? I think that's important to do to make the clear distinction that income statement serves its own purpose and balance sheet serves its very distinct purpose.
Yeah. So the important thing to understand about the balance sheet is it is a window into the financial health of the company, right? So companies can be structured differently, and we talked about this in the debt and equity episode. When a company is founded, they can borrow money, they can sell shares in the company to generate cash to run a business. So depending on how, you may have two businesses that operate in the exact same industry and the exact same, sell the exact same goods and so on, but they are financially structured differently. So they may have higher debt versus equity in one company, and the other company may have no debt at all. So, the idea here is that you look at the financials to identify, how healthy is this business? Is it going to run out of money? Is it going to have, run into a financing problem where they need to continue to grow their business, but nobody's going to lend them money because they already have too much debt, on the balance sheet. So these are all of the things that you kind of look at when you're looking at the balance sheet, and it also tells you a lot of information that is important to how quickly does how quickly would they run out of money. So in some cases they have they have short-term financing problems or long-term financing problems. But at the end of the day, the only reason a business goes out of business is that they run out of cash, right? They have to pay too many people and they run out of money. So
Right.
It's very important to understand this from a financial standpoint, and hopefully that when you start investing, you are able to piece through this and get these concepts.
Yeah. I also want to point out one more thing that's, at least for me, was really helpful with understanding balance sheet and why it's so different and why it serves, as I said before, it serves a very distinct purpose than, let's say, income statement or cash flow, is that income statement is how the company did in a given period of time. I think this is very important to emphasize. In a given period of time, let's say this quarter or this past year. Whereas balance sheet is a snapshot in time, like Hari said. This is one snapshot in time, the financial health of the company and what the company owns and owes. And so, at least for me, it was very helpful to think in that way. So income statement is how the company did over a period of time, and balance sheet is, okay, after that period of time, what happened to the bank statement of the company?
Yeah, I mean, I think the other way to think about it is income statement tells you how is successful is the business in its operations, relative to other periods of time. And a balance sheet is more about financial health. It doesn't tell you a lot about what business this is in. I mean, although there are some things that you'll see with different balance sheets, but it doesn't tell you how successful the business was at turning, generating profit and things like that.
Right.
What it does tell you is just, how much money do they have? How much money do they owe?
Yeah. Yeah. Okay. Enough of the overview. Why don't we dive right into kind of the details of the asset part of the balance sheet.
Yep.
This is usually on the left side of the balance sheet. And take us through the anatomy of assets.
Sure. So I think the most important thing is there is a accounting test that they use in order to what quantifies as an asset, right? So an asset must be valuable and it has to be quantifiable. So there has to be a way to assign a dollar amount to that, in order for it to appear on the balance sheet. So what is interesting about that concept is, if a company has like a brand or a trademark or something like that, it may not necessarily appear on the balance sheet simply for the reason that there is no way to measure what that asset is worth. Now, it may be incredibly valuable. I mean, think about the Coca-Cola logo, the Coca-Cola brand,
Nike,
Mickey Mouse,
Starbucks.
Yeah. All of these things have an enormous value to their company, their respective companies.
Yeah.
And you can say, well, they can license this brand or something like that, but that's not how it necessarily works here. You have to think about it from the perspective of, I'm an accountant, I go and buy a building. A building is easy to value and quantify. A trademark is much more difficult because anybody can trademark something, right? And that trademark, if I trademarked, Value Investor TV, it doesn't have the same value as a trademark for Disney, for example. Mm-hmm. Maybe one day. Maybe one day, but
maybe one day, yes.
Not today. So, it's important to understand that because the valuation and quantifiableness of this is very important. And what you'll see as we talk about this, is when companies exchange, when a company buys another company, then there is a valuation that can occur at that time. And when that valuation occurs, now the valuation of certain intangible assets like trademarks can appear on the balance sheet.
Yeah.
But if we were to create that, it doesn't show up. So there's some interesting parts of accounting rules that we'll talk about as we go through this, and some many of them may not be in scope for this intro talk, but we'll kind of lay those out as we shift over to start talking about companies, we'll kind of hammer on some of those things.
Yeah. Again, to highlight Hari's point, to reiterate, asset must be valuable and quantifiable. So it must be able to assign value and should be quantifiable. And that's the accounting rule for assigning something as an asset, classifying something as an asset. So we have to make sure that we have that in mind before we actually dive into the asset part of the balance sheet. So why don't you take us through how it's laid out? We talked about in kind of making an analogy to the income statement of how we start from the top line, all the expenses are thrown out, and then the bottom line. It's easy to understand these things if you understand the structure, the anatomy of how these financial statements are arranged. So there is a rule to how these assets are laid out in the balance sheet. So tell us about that, Hari.
Yeah. So let's start with at the very top, there's a convention that's very important. It applies to assets and liabilities, which is as you go from the top to the bottom, it goes in order of descending liquidity. So that's a fancy way for saying how quickly does it become cash. So at the very top of the balance sheet, you have cash already. So this convention also applies to what they call current assets and non-current assets. So current assets are assets that will get converted to cash or expected to be converted to cash in the next 12 months. Non-current assets are greater than 12 months. So when we talk about descending liquidity, it's how quickly is that going to be converted to cash? So cash is already cash. Then they have this thing called short-term investments, which are and to be just to add one more thing to that cash. Cash may also be cash in foreign bank accounts. It may be cash that is, in when they say it's in foreign bank accounts, they will report it all as U.S. dollars. So on that day of that the snapshot occurs in the balance sheet, they will convert all of that from whatever currency it's in. I mean, think about Coca-Cola. They have operations in basically every country in the world. They also have bank accounts in every country in the world. So when they put together this balance sheet, they are telling you what is that U.S. dollars, because that's how they report.
Before we move further, could you, for very beginner listeners, liquidity might be kind of an odd word for them.
Sure.
Could we define it before we move on?
Yeah, so liquidity means it's how readily available is that to be converted into cash. And so when you talk about liquidity, it's if you think about it like if I buy a piece of artwork, right, and I buy a rare Picasso, the market for Picassos is not like the stock market. The stock market has there's lots of transactions, lots of buyers and sellers of, every single day, 5 days a week. So that liquidity is I'm able to convert my stocks into cash very quickly. It takes me a lot longer to convert my Picasso into cash, right? Or even something less rare like real estate. You put your house up on the market, it may take 30, 60, 90 days for it to convert. Whereas in the stock market, it may take 10 seconds, or 5 seconds, however long it takes me to log in and click on things, right? So when you start talking about liquidity, it's how quickly can they convert that. So, think about a company like Toys R Us that has inventory, right? So they buy a bunch of goods from their various retail channels. How quickly can they convert from their inventory into cash? And so that is when something gets purchased. So, as we start talking about this, you'll see that it's harder and harder for these things to get converted to cash. Sometimes faster, sometimes slower.
So with that in mind, with that definition in mind, why don't we go back to the kind of anatomy again? So you talked about cash. This is under current assets. So cash as the most liquid. I mean, it is definition of liquid asset.
Right.
It's cash.
Yeah.
You can't get more liquid than that, right?
Yeah.
Next in line is what?
So short-term investments. So what will happen is generally companies will have chief financial officers, accountants, and other things who will say, we're not going to use this cash for 6 months, so we'll put it in a treasury bill. So this is, the U.S. government issues treasury bonds. And so that way we'll get a better interest rate than just leaving it in the bank account, right? So sometimes they have these short-term investments that are just there for 3 months, 6 months. But the idea is that they will be cash. So mentally, I don't treat that as any different than cash. It's they can convert it whenever they need to. And in many cases, the short-term investments, there's also a market to just sell that asset, if they need the money immediately. So, it's effectively just cash already.
Yep. Next in line, go ahead.
So accounts receivable is the next one. When we talked about the income statement, we said that a company has to sell an item, right? So when they sell an item, they ship it to their customer. That is counted as revenue at that point, right? But what is revenue is not necessarily what is cash, right? And so the way that they track how much is sold but hasn't been paid for is in this accounts receivable line. So depending on the type of business, if you're a wholesale manufacturer of something, you may have a large accounts receivable section. Whereas if you're a Toys R Us or something like that, you may not have any accounts receivable if everybody pays you in cash, right, up front. So, this is going to be business dependent, but effectively it's you've given your supplier, your customer 30, 60, 90 days to pay you. And so, based on how long it takes them to pay, this number may fluctuate. So, it's hard to say that you can just look at these two numbers and, year to year and just say, hey, this is changed. Because again, it's a snapshot in time. So, obviously if accounts receivable just keeps going up, far exceeding the number of, relative to revenue and stuff like that, companies may be extending more and more credit to their customers. And maybe that's a problem. Maybe it's not. That's something that you'll have to read in the footnotes to all of this stuff.
Right. And the next in line is, you want to talk about the next item?
Yeah, so inventory is the next one, which are things that are going to be sold. So inventory is probably what you would think. It's depending on the type of business, it is unfinished goods. So like you buy materials from your suppliers to build something, that goes into inventory. It includes finished goods, so things that are, have been completed. And, the way that inventory is measured is essentially a company builds something, it gets put into inventory. The inventory is sold, and that becomes, your accounts receivable. And then when the accounts receivable gets paid, your cash increases. So just like we saw in this current assets, right? We went from descending liquidity. If we're going backwards up the chain, right? We start with the inventory, we go to accounts receivable, and then we go to cash. And that stepwise process is occurring because we are converting things into more liquid things.
Yeah. I'm going to go ahead and then summarize that part because I think that's very, very important to understand.
Yeah.
This structure, right? This rule. Everything's rule-based here. So, again, descending liquidity. Start from, if you look at current asset, part of the asset, you'll start with cash, most liquid, and then you'll move down the chain all the way to inventory. Yep. And then if you reverse that thought process and go from the bottom up, effectively that means, okay, I have this much inventory, receivable, and then cash. So you can think in both ways, but effectively it's the same kind of mindset of liquidity.
Right.
Ascending or descending liquidity.
Yeah, so let's also, while we're talking about this, I think it's also important to understand companies are planning to sell this stuff within the next 12 months. But, if you remember back to, companies make mistakes, they decide to, market something or whatever, and it just doesn't turn out to be what they expect, right? And so when we start talking about these things, inventory can't just sit on the balance sheet forever. So if they realize that people are just not buying what they expect to buy, they may have to write down the inventory and say that these goods are not being sold, and then they actually will take a hit to their income via one-time expense for writing down this inventory. So, we'll do a wrap-up talk about, putting these things together, all of the financial statements together. But it's important to understand that the inventory, accounts receivable, and cash both tie into the cash flow statement and the income statement. And if you can't sell inventory, then you have to take a charge against your income statement for that year.
Yeah.
So that's how these two, kind of statements tie together. And we'll talk about that more when we put it all together. But just keep that in the back of your mind.
Yep. Okay, so that was current assets, right? Again, as a reminder, current asset is everything that we listed here can be converted into and slash will be converted into cash.
Yep.
That's what current asset means. Okay, if you contrast that with long-term assets,
right,
which is assets that the company doesn't want to or doesn't think that they should convert them into cash.
Yep.
So that's long-term assets. So kind of have a mental picture. Okay, asset, you break it down to two: current, long-term, and within those two bubbles, everything is in liquidity order, like we talked about. So let's go into that second bubble, which is long-term assets.
Yeah, so long-term assets is think about long-term assets as things that the company uses over a longer period of time. So they have a useful life of multiple years. And, think about buildings. So the term that they use is property, plant, and equipment. So property obviously is land, buildings, that kind of stuff. Plants are, manufacturing plants, warehousing, and equipment is, the steel mill saw, the equipment that, you use to manufacture things, your shipping, that kind of stuff. It even includes things like cars, for if you're a shipping company, things that you have on the asset side of the house. And these are also, fixed assets because they are, for the most part, you're not selling these items as part of your day-to-day business. So they are assets that stay as part of your business. They will last longer than a few years. And because they are there for multiple years, they're going to get removed. You may end up selling those things at a later date, but that's not part of your operations. Now compare that to a car company who, the car, yes, it'll last more than 5 years, I hope, right? But a car is not a long-term asset for the Ford Motor Company. The car is what they actually sell. Right. So you would see that in inventory and accounts receivable and so on. So, it's important to make the distinction between those two, because fixed assets versus, what we would call intangible assets, right? And so that is, intangible assets are things that, again, you have to put them in they have to meet a certain criteria, which is valuable and quantifiable. So what happens is companies actually have what's called goodwill, right? And so goodwill is actually the result of purchasing another company, right? So let's say that our hot dog stand had, wanted to buy a rival hot dog company. So what they will look at is they'll say, what are the assets and the liabilities of hot dog company competitor, right? And they'll say if they have $100 in equity, but you pay $150 for the company, what will get marked on the balance sheet is we will get their assets, we will get their liabilities, and they will appear on our assets and liabilities. But then they will also mark the extra $50 that we spent and put that into goodwill. And the reason that exists is that the goodwill for that is an accounting, concept to tell you that you spent money on an asset, you spent more than what, than just the sum of the assets and liabilities that they had. And so by, merging these two concepts together, you have this leftover, and they call that goodwill. The reason that that's important is that sometimes companies will buy other businesses. They will accumulate an enormous amount of goodwill because they've paid over the asset minus liability, the equity price, and then that company that they purchased, they don't know what to do with it. They can't actually get it to work, and then they will take an expense against their income. And so you'll see that as a write-down of goodwill, just like we saw a write-down of inventory earlier. And so it's important to keep these things in mind, is that, first of all, if you're paying something above the asset price, you get, you get to keep, this, goodwill recorded. And it's important to see, to kind of look at that and say, especially a lot of tech companies will acquire a lot of businesses. They will pay a lot more than the asset that the business has on hand, because tech companies typically don't have a lot of assets. And as a result, they may have a large goodwill component to their asset base.
Right. So long-term asset, just kind of recap here. So we talked about property, plants, equipment, fixed assets. Those are the things that the company uses to operate. So, for example, in our hot dog stand, a fixed asset could be our cart. What else? Hot dog machine,
our storefront,
all that would be categorized under long-term asset and fixed asset. And Lahar said, let's say we wanted to go buy another hot dog company, but we paid extra $50. That $50 we marked here in goodwill. So we talked about that. Anything else you want to add here?
Yeah. So the important thing also to remember is every, let's say I buy a building, right? I mark on the asset, on the balance sheet, what is the price I paid for the asset.
Oh, yeah.
So let's say over a 25-year period, that building, the real estate in the area has appreciated significantly.
Yeah.
I do not increase the value on the asset on the balance sheet for that asset.
Yeah.
And the reason for that is it's very difficult to quantify that change, because until I actually sell it, I don't know what it is worth, right? And so there's some argument about, well, this, company could have a lot of assets that are worth a lot more than what is recorded on the balance sheet, but you don't, identify it correctly. So it's an interesting quirk of how the accounting works, is that if there is a permanent loss of value in an asset, they are required to write down the asset. But if there is a gain in the asset, but it hasn't been sold yet, then you don't get to increase the value on the balance sheet. So just a interesting, quirk of how, actually it makes a lot of sense. It's not a quirk. It makes a lot of sense to do what they're saying, because it accurately reflects how much was the price that was paid for a certain asset.
Yeah, exactly. And as an investor, I think maybe you want to chime in on this too. As an investor, it's actually a very interesting place to look for hidden values, because companies, for example, I know you mentioned Macy's, for example.
Yeah,
they bought a real piece of real estate, and they have this gigantic real estate in New York and San Francisco as well, I believe. And they bought it long time ago.
Yeah.
And so the price they paid, I don't know when, but many decades ago, the price they paid then obviously is much less than what you paid now because of inflation and everything else.
Yeah.
And so if you look at their balance sheet, it may look not substantial, but if you actually step back and think about it, oh well, this is the accounting rule. So if you actually sell this property, you can get a lot more cash for that.
Right. And so the only time that they would see it is when the actual sale occurred. Yeah. So, it's important to understand that, because some businesses have, it is better for them to sell the property than it is to actually continue to run, operations through that. And maybe you sell the property and then move to a cheaper location, pocket the money for your investors. So thinking about it from that perspective, as we talk about activist investors and other groups who would try and unlock value from a company, they may buy a business seeing an asset that is, underappreciated or undervalued on their balance sheet, and then push for the company to either sell it or make some changes to unlock that value. So, right. And that may be a good place to look from an investor standpoint. they're not necessarily easy to find, but when you do find one, it could mean a tremendous amount of value for you as an investor.
Mm-hmm. Okay. Do you want to talk about depreciation, amortization?
Yeah.
Here.
So let's talk about depreciation for a minute. So we had talked about property, plant, and equipment, and we had said in the income statement we had talked about what depreciation was. So, this is a non-cash expense, but it is a real expense over the long term. Is that that car or truck that you buy that you use to haul supplies, our hot dogs to our various stores. Over time, that truck breaks down. We have to replace it. But rather than just expensing the replacement cost as a one-time thing, which will appear in the cash flow statement, we actually take what's called accumulated depreciation, or we say every year we take, if the asset life is 5 years for a truck, we take 1/5 of the asset every single year as an expense, and then we mark on the balance sheet depreciation costs. So we say that the fixed assets minus the accumulated depreciation is net fixed assets. So for the most part, land is not depreciable because land is land, but buildings, equipment, and other goods that fall under property, plant, and equipment will be depreciable. And so the idea is that you would replace those, but not every year, or you would replace a percentage of them every year, depending on what needs to be fixed. So, you may have a truck that is on the balance sheet that is worth nothing because it's completely depreciated out, but you still can use the truck, as an asset. You just can't take an expense, a hit to your taxable earnings, as a result of that. So accumulated depreciation is something that we'll probably talk about it a lot over time. It is an abstract concept. Some people, it takes a little while for them to understand it. But just know that, this is how we link the income statement and the balance sheet is we accumulate the depreciation that has occurred in an asset over time. And that asset loses value based on how much, depreciation has been accumulated. But that doesn't necessarily mean that it doesn't have market value, which is different from the accounting value here.
Right. One of the things that was interesting when I first looked into this was there's a set of rules that all these accountants go by where you have boat, for example, a large boat will depreciate by this percentage. Excuse me, a building will depreciate by this percentage.
Right.
That percentage of depreciation that you take out every year or every so often is kind of standardized and set.
Right. Yeah. There's standard accounting rules called GAAP, which we talked about earlier, the generally accepted accounting principles, that tell you what are the rates of depreciation.
Yeah. So that was interesting.
Yeah.
That was very interesting. So that's anything else you want to add here, the long-term asset part of this?
So I think this is more of an abstract concept also, but even more so than depreciation, but amortization is the same concept. But it applies to intangible assets. So the value of, say, a patent, which is an intangible asset, which you purchased from another company, which is how you quantify the asset, can amortize over a 17-year period or a 5-year period, depending on how long the patent is for. And then you can take expenses against that. So depreciation is against fixed assets. Amortization is against intangible assets. Both are expenses that you'll see on the income statement that'll occur as expenses but aren't necessarily cash expenses.
Yeah. Okay, so that was the kind of overview of the long-term assets. Again, going back to the high level here, liquidity, descending liquidity, very important to understand the current assets. And then we also talked about the long-term assets and depreciation and amortization. I know this is, this could be kind of difficult to wrap your head around. I would recommend that I'd advise people to kind of read about it online, listen to this podcast multiple times, because certainly for me, it took a few trials to fully understand the meaning of these things and what it means as an investor.
And if you have questions, just you can email us, find us on Twitter. or Instagram, or leave a comment, and we'll be happy to look at and answer your question.
Yep. Okay, so that is the asset part of this balance sheet. We talked about quite a bit here. And then we'll move on to the next episode on the other side, the right side of the balance sheet equation, which is equity and liability. We'll talk about that in the next episode. Well, thank you for joining us on episode 16, balance sheet assets. So we'll see you on the next one.
See you then.